In this recording, we're going to look at the first topic in Section 3, short-term decision-making, focused on cost, volume, profit analysis. Now remember, these are optional for this academic semester because of the condensed semester, so you can have a look at them, particularly if they're interested in your roles, but again, they're not mandatory, so they will not be on the exam itself. So what we're looking at here in terms of CVP, this is looking, as the name suggests, at the relationship between cost, volume, and profit. So for example, if you double your volume, what way will cost behave and what way will profit interact with that? So if you're an airline and you're trying to figure out, well, if my volume, my occupancy in the plane is 50%, how does that impact my cost and my profit versus if it was 70%? Same if you're thinking about a hotel, you're an airline, your restaurant. This is quite important, and the management accounting offer very important tools and techniques that can give you very practical answers. Is what level of volume do you need, for example, to break even? What level of volume in the business do you need to reach a certain level of profit? So quite very practical answers. So we finished up last week looking at strategic cost management. We looked at how ABC costing information, which we covered week 2, can be used in a more strategic perspective. For example, using activity-based management, ABM. And that can be looked at from an operational perspective or an also strategic focus as well. And we left you with a small bit of extra work to do at the end of week 3, looking at other developments in cost management and the kind of tools and techniques management accounting is providing to businesses to solve more modern business problems. And that's around the examples of life cycle costing and target costing. So where we're moving on to today then is we're going to look at, and this is important, short-term decision making, because that will influence what way we view costs in the short term. And particularly what we're looking at here is routine decisions around the relationship between cost, volume, and profit. So it's often called in short CVP analysis, your cost, your volume, and your profit. And what essentially we want to know is how do costs behave when we change the level of activity? So if we go, for example, from 50% occupancy in a hotel to 80%, which costs move in line with that and which costs actually stay fixed? Because regardless of whether you have 50% occupancy or 80%, that money is going to be spent. So it has very much practical applications. If you want to know what's your break-even load factor, is what we call it in an airline, how many bums on seats, this is what you would use. If you want to know your break-even occupancy rate in a hotel, this is the kind of principles that you would use for management accounting. So it does give very practical questions and very useful information. All right. So this financial accounting or financial information for decision making, we've looked at accounting information for cost management. Right, we're now looking, well, how can it help to make decisions? Particularly here, we're looking at the shorter term decisions. For longer term decisions, you will be doing this thing called investment appraisal, which will be in your corporate finance module. This is where you're looking over 2, 3, 5, 6, 7, 8 years at bigger, longer term projects, in which case you have to be a bit more detailed and rigorous in how you account for financial figures and how you deal with those. But again, remember, the whole purpose here is taking management accounting techniques. We looked at ABC, we looked at ABM for costing, and we're now looking at other techniques to inform decision making. But remember again, have your managerial hat on. You are doing an MBA. It cannot be the decision making process. So you can't just say, well, this is what CVP said, this is what we're going to do. There's a huge amount of other considerations to think about. And remember that thing we looked at the end of week 1, the fact that accounting is just one window into an organization. You have to look in the other strategic, operational, marketing, human resource management issues as well to consider. So there is financial, but there's also non-financial as well. In this week's and this recording, we're going to look at routine decision making. This is regular decisions around setting prices, volume decisions, and the cost structure. Right. In the next recording, which is optional as well, called relevant costing, we're going to look at more one-off decisions or non-routine. So for example, should you outsource production? Should you accept a special order? Should you have a special price in a particular contract? So we're going to look at that concept in a different topic known as relevant costing. But again, it's about using accounting information in a particular way to inform decision making. But for this particular recording, we're going to look at more routine decisions. So the regular pricing, the regular volume decisions around day-to-day management of a business. So CVP analysis, as the name suggests, it looks at the interrelationship between revenue as part of it as well, but cost, volume, and profit. because of course profit is revenue minus costs. So what we want to, for example, answer questions is, what's the level of sales needed to break even? And that's very important now when you're thinking of COVID and the restrictions. You think a lot of restaurants, a lot of cinemas, a lot of hotels are saying, look, it doesn't make sense for us to open. We don't have a break-even level of occupancy. But you have to ask yourself, well, how would you come up with that? How would you come up with a break-even occupancy rate in a hotel to make sure it breaks even and covers the costs every night? How would you come up with that in terms of a restaurant or in terms of an airline? So this is what CVP, the tools management accounting, provide. What volume do we need to sell to maintain current profitability? So if we want to maintain profits at the current level, what volume do we need to sell next year, taking account of price changes or cost changes? Can we change our pricing structure? And how will that impact our profits? For example, if we incur additional costs, what changes do we need to our price or volume to mitigate this? So it's a very practical thing. For example, if we want to bring on another salesperson, how much extra sales do they have to make so that they cover their costs? A very practical thing. How does a change in our cost structure affect our profitability? So if we change our cost structure and we automate part of our production process, or we outsource part of our offering, how does that change our cost structure? Does it increase our risk or decrease our risk? So all of these very practical, very pragmatic questions, we can use management accounting techniques to help inform the answer. Now, it's not going to give a perfect answer. It's not going to tell us what to actually do, but it's going to inform our decision-making process. And that's the big thing we focused even the last 2 weeks about accounting information is it will help inform. It's not going to make the decision. That's your role as a manager. That's why you're going to be paid your salary to make an informed decision, but it's going to help understand the key considerations. So what we're looking at here, last week we looked at classifying costs by indirect or direct. So we're saying how easy is it to attach those costs to cost objects. In this recording, we're looking at classifying cost by cost behavior, i.e. how does the cost behave when we change the level of activity. So if we go from 50% occupancy in a hotel up to 80%, which costs move in line with that? So are the costs variable, that the more activity that you have, the more of those costs that you have? So if I produce extra boxes of cereal, a variable cost will be the cardboard in the cereal packet, and the grain in the cereal, the flavors in the cereal, etc. However, some costs do not change. These will be fixed costs. So for example, if I go from 50% load factor, as they call it in an airline, on a flight to 80%, still the same pilot salary. The pilot is still getting paid the same whether there's 5 people on the plane or 50 people on the plane. That would be a fixed cost. It's fixed regardless of the level of activity. And then some of those costs can be mixed. Think of your telephone bill, where you might have a flat rate a standing rental charge, and then you may have a usage charge depending on the more calls that you make. Same at ESB electricity, you have a flat standing charge and then you have a usage related charge as well. So some costs can be mixed. Part of it is fixed, part of it is variable. But start to think now why that might be very useful if you're trying to project what impact costs have when you change level of activities. Because this will impact, it's not a case of, well, if occupancy goes up 10%, cost goes up 10%, because some costs may not move at all. So having an understanding of your cost structure and how they behave is quite important for those types of businesses. So we can see here cost behavior. A variable cost, as the graph shows, is the level of activity in the cost. It goes up in line with the level of activity. So the more level of activity you have, the variable cost goes up in that relationship. Now again, these are assumptions. Not every cost in a model is going to be exactly the same, right? But we're making model assumptions to make this work. A fixed cost, for example, doesn't move at all. So whether you have 10% activity or 50%, it's a fixed cost. So for example, their rent in a warehouse or your insurance cost, they're relatively fixed. So regardless of what's happening, you still have to pay for that. Now you can also have something called a stepped fixed cost. That might be, for example, in renting a warehouse where is one warehouse gets filled up, you have to jump up then and now you have to rent 2 warehouses. And so it steps up. So it goes along like this, and then it steps up when you go to another warehouse, and then when you go to the third warehouse, it steps up vertically and moves on again. because it's more in tranches rather than a slow and steady increase in the cost. And then you can have a mixed cost, which for no level of activity, you still have a certain amount of cost to cover. But then as activity goes up, it also jumps up as well. So you notice in the fixed cost and the mixed cost, even at no level of activity, you still have to cover those costs. And a lot of businesses now are finding out that, for example, when you're looking at COVID-19 and the business are closed, rent still has to be covered, right? Even if you're not generating any activity, you still may have rates to cover. You might have insurance to cover unless you're getting some waiver from your suppliers in terms of those costs. So that's coming very much in focus now with a lot of businesses where their revenue has dramatically fallen because of the COVID restrictions, but a lot of their costs are fixed costs and they still have to be covered. And that increases the risk in a business. Right, so your total cost curve then, or your total cost graphic, is your fixed and your variable added together. And of course your mixed are in there as well. Right? But that cost function is very important, that it gives you an idea for different levels of activity where along that cost curve you might be. And you can compare that to your revenue then to get an idea of, am I going to make a profit or a loss at that particular level of activity. Now remember, this is a theory. This is a model in accounting, so it's never going to be perfect. Like, it's going to be very hard to split every cost easily into, is that exactly a variable cost? Is that exactly a fixed cost? But you have to do that for the purpose of the model. So it is simplistic, but it may not be fully realistic. So there is elements that you're saying, look, there's going to have to be some guesswork or some estimates done. But the point is, it gives you a good insight into what you have to think about. Right? And generally, CVP is only valid within a certain range. That when you go outside that volume range, so when you go to extreme levels of activity or unusual ones for your business, that can change then. Variable costs can change because you might have economies of scale. Fixed costs can change because you might have a step fixed cost. If you go to a certain level of activity, you might have to hire a new warehouse, which increases the rent. So it's important to realize that these CVP analysis does come with a set of assumptions. Now, one activity I always get students to think about is, we'll think about hotels. What are the types of cost behavior that you might have in terms of variable, fixed, and mixed? Well, for example, your variable costs, that'd be the cleaning per room, right? So if you had a cleaning contract that is cleaned, people are getting paid per room, the more occupancy you have, the more cleaning costs you have per room. Likewise, in terms of meals, the more occupancy, the more meals, the more meal cost that you have, the more breakfast cost that you have. Whereas a fixed cost here, you might say, well, fixed cost might be insurance, because you have to have insurance for the year, might be a fixed sum, so it doesn't matter the level of occupancy. You might also say some labor costs are going to be fixed. So for example, your financial accountant, your general manager, your HR manager, right, your maintenance manager, all of those are probably going to be fixed wage permanent employees. So regardless the level of activity, they're going to have to be paid. Now, again, we're starting to see there may be some complexity to say actually some cleaning contracts might be fixed as well, because you might have a fixed cleaning contract for the year, regardless the level of activity. So it's important to understand the business model itself and understand, well, what is the actual nature of this cost? How does it behave? Some costs may then be mixed. So for example, some of your labor cost might be fixed, but other labor costs might be per hour. And you might have a contract per hours depending on how busy it is during the week at the hotel. Likewise, some hotels may have franchise agreements. So to use the Clayton brand or to use the Radisson brand, you may pay a fixed fee per year, which is a fixed cost, but you may also pay a percentage of your turnover, which is that variable element that as your turnover goes up, your level of activity, your costs go up as well. So it's just to bear in mind, even for something as simple as a hotel, thinking about the cost structure can be different. Some cost structures may have very high fixed costs, with labor costs, with light and heat, with maintenance costs. Other costs may have a lot of variable costs because you might outsource a lot of your cleaning and pay on a per room basis. You may outsource maintenance and pay on a per hour basis. So therefore, they're more flexible in terms of cost structure as well. So we're just trying to show you that think about your business and think about the types of costs in your cost structure. The more fixed costs that you have in your cost structure, the riskier it is. And a lot of businesses are seeing that now. Think of airlines. They have a huge amount of fixed costs. People, they have a huge amount of fixed costs in terms of planes, whether they're leasing the planes or whether those planes are standing and they have to be financed through debt repayments. But if those planes are not in the air and their flights aren't running, all those fixed costs still have to be covered. So for all those types of businesses, understanding the cost structure is hugely important. Right? So one key concept that we're going to introduce now is this concept called contribution. And this is the difference between your sales revenue and your variable expenses or your variable costs. And the reason it's called contribution, it's the amount left over to cover or to contribute towards your fixed cost. So for every room I book in a hotel, I take the revenue from that room and I take off the additional costs from covering that room. So the cleaning costs, the admin costs, etc. So it's essentially like the marginal or incremental profit per unit. So it's the incremental profit for every extra airline ticket sold. It's the incremental profit from every extra sitting I have in a restaurant or every extra ticket I sell in a cinema. And it contributes to fixed costs. So it's an important way of looking at your cost structure. So contribution. So take, for example, this here, simple example, company X. Right? Sales level is 5,000 units for the year. Right? It sells every unit an average selling price of 20 euro. That's fairly straightforward. And it has variable costs. So variable cost means for every unit it sells, it spends 14 euro to get it to be sold. So it buys it for 10 euro, it pays commission of 250 to the salesperson, and it delivers it for 150. So that means for every unit it sells, it costs it 14 euro. And that's ignoring other costs, fixed costs. So that could be the head office costs, that could be light and heat, that could be your general manager costs that are outside the actual unit cost. But they have to be covered as well. Right, so think about it from a unit perspective. So for every unit the company X sells, and this is important, it gets 20 euro in, but it spends 14 euro. So the net benefit from selling a unit is 6 euro. That's what we call contribution. So for every unit, and this is important, for every unit company X sells, it earns 6 euro contribution. And that 6 euro will go towards covering the 20,000. So you can start to see already, well, that means we can figure out how many units at 6 euro we need to sell to make sure we cover all our costs. The 14 is already covered as part of here. So our contribution here is going to be 6 euro. If we only sell one unit, that means we've made a contribution of 6, but we have fixed costs of 20,000, which makes we're going to make a loss of 19,994. Because again, we haven't sold enough to cover our fixed cost. Remember the nature of fixed costs do not vary. So if I sell 5,000 units or I sell 5 units, fixed costs are still 20,000. So that's the benefit. The more we sell, the more we can spread our fixed costs over a higher number of units. That's the whole concept of economies of scale as well. All right? So think of the profit or loss here for 5,000 units. If I sell 5,000, I make total revenue of 100,000, 5 times 20. I have purchase costs of 5 times 10, 50,000, 5 times 250, and 5 times 150. So my contribution is 100 minus 70. For the smarter people among us, you'll be able to jump to that quite quickly and say that's actually just 5,000 units at 6 euro. So you can cut to that a bit more easier, which means 30,000. And that means I'm going to make a profit because my 30,000 contribution more than covers my fixed costs for the year. But the nature of this structure and having your cost base split out like this is, I can estimate my profit now for 4,000 units. I can sub it in here. I can estimate my profit for 7,000 units. But that's based on the assumption, and this is important, that your costs do not change, right? That within that volume, variable costs remain the same. So for example, if I go to buy 10,000 units, maybe my purchase price falls because I'm getting a bulk discount. Or if I go to 10,000 units, maybe my fixed costs change because now I have to take on another warehouse. So it steps up because of that. So it is a simple approach, a very simple technique, but it gives powerful insights if it's used correctly. So if you're aware of its limitations, but you can still use it to give informed decision making. Right? So one way we can look at it and express it is this thing called a contribution margin. Contribution margin ratio says. So if you put the contribution over the revenue. Remember margin we talked about already, a markup margin. Margin is a profit figure over revenue. We're using profit now as contribution. So the 6 over the 20 is 30%. So what that means is for every extra euro in revenue, I'm earning 30-cent contribution. So the higher that is, the more profitable you are. And remember, contribution is telling you how much of that is going towards covering your fixed costs. So it's quite an important insight. So just bear in mind, we can represent contribution on a per unit basis, for example, €6 per unit, or we can represent it on a percentage basis. So if you were told the revenue is €20 and contribution margin is 30%, that's also telling you contribution per unit is €6. So watch for those in exam questions or in shorter questions that you should be able to understand it from both perspectives. All right, so that's going back to margin and markup again. So the nice thing about a CVP is you can actually use Excel now and graph it out. So within a certain relevant range of output, where these assumptions hold, you can actually take each level of output and say, well, what is the total revenue? What are the total costs? And graph it out. And that's what I've given you in an Excel file, and that is up on loop. And we look at it here. I've taken a range of output from 0 units all the way up to 8,000 units in tranches or jumps of 500. And I say, well, what is the revenue? That's straightforward. The revenue we're assuming is €20 a unit. So at any level of output, you multiply by 20. 6,000 times 20, €120,000. No units, no revenue. 8,000 units, 160. And we graph that curve here, the red curve. So that red curve there is your total revenue. It starts at nil, because if you make no sales, you have no revenue, and it goes all the way up to 100, and in this case, 60,000. Right, so it's only to 7,000 there I've graphed. You can graph it out if you wanted to. So similar with total cost, we look at variable cost, which are, as we're told here, your variable costs are €14 per unit. So if I sell no units, I have no variable cost. If I sell 3,000 units, 3,000 times 14 is 42,000. But you'll notice here the fixed costs do not change. So they are fixed element right the way along. So our total cost then, even when we've no level of activity, we still have 20,000 to cover. That's the same with airlines now, which are shut down for COVID. They still have costs to cover. Same with restaurants, same with hotels. The more fixed costs that you have, the riskier the business is. Because if you have a downturn, for whatever reason, you still have to cover those fixed costs. And that includes debt and interest costs as well. And as your activity rises then, your costs rise because your variable costs increase. And what we can see here is the blue curve eventually crosses over and matches the red curve at a certain level of activity. So we can see it there somewhere around there, somewhere around 3,300, costs equal profit, costs equal revenue. And that means that's your break-even point. But we can show that mathematically how to calculate it. Anything above that, we can see here, we make a profit because revenue is bigger than total costs. Anything below that, costs are bigger than revenue, so you make a loss. And I drew a second line here. This is the line at 5,000, where our total costs, if we go back to the slides, our total cost at 5,000 would have been 90,000. Variable at 70, fixed at 20, that's your 90,000 roughly there, but our total revenue was 100. So that little difference there in the middle, that's your 10,000 profit at 5,000 units. So that, and this is getting back to, remember we talked about in the whale curve before as well, in terms of customer profitability analysis. It's the power of visualization. That if you can visualize that, we can see the break-even point now, but we'll calculate that accurately as well. We can see where the profits are, we can see where the losses are. It makes it more engaging. Right, it makes it easier to sell your message to non-accounting people as well. And think about that in your own roles. I'm just showing you basic examples of where you can take very simple accounting figures, but visualize them and send a message or tell a story more effectively than you can with a big table of numbers. Like if you gave this table of numbers out, people would not engage with it. If you gave this visual out, it's easier to engage. So think of that in terms of the power of visualization as well. So when we come back then, we can get a sense of, I've identified now where my total costs overlap with my total revenue, which means I neither made a profit nor a loss. The total revenue for the year just covered the total costs. And this is the next key term we're looking at, is the break-even point. And we're trying to figure out how many units at €6 per unit contribution do we need to sell so that we break even, i.e. that it covers the fixed costs. Now look, a lot of you jumped ahead already and said, sure, that's simple, and that's perfect. That's what we want you to engage with. But that's a very practical thing. Restaurants have to think about that. How many covers, i.e. people sitting at the table, sittings do we need to have each night to break even? How many bums on seats do we need in a plane to break even? How many heads on beds in a hotel do we need to break even? So every organization can think about this, and accounting gives the tools to think about it. So the break-even point is when the contribution exactly equals fixed cost. If you sell above the break-even point, you earn a profit. Where sales are below the break-even point, you generate a loss. Right? So if you go back to our example here, what is the break-even point for this company X? Well, we know each unit generates €6, and we know we need to cover fixed costs of 20,000. So 20,000, the fixed costs divided by the €6 means you need to sell 3,333 units. If you sell those units, because you can't sell a partial unit, so we'll probably just go up to 3,334 times 6, that just about covers your fixed cost. So you have €4 profit left over. So you can't have a partial number of units. You have to sell a full amount of units. So we've kind of figured out then how to approach it. You can do a complicated formula like that, but the simple approach is you take your fixed costs and you divide by the contribution per unit. That's where the formula comes from. It is fixed costs over the CPU. And look, you don't, of course you need to know the formula, but it's not going to be examined because this is optional for this semester. But what we're trying to think is just consider the problem before you try and calculate it. Well, so consider the problem in English to engage with it. Just try and think, oh, I have to learn off this formula. It's if I make €6 from every unit, how many do I need to sell to cover 20,000? And that's an easier way of engaging it. Same with an airline. It's if I make €20 from every ticket, how many tickets do I need to sell to cover the cost of the plane? Or if I make an average of €100 for every table sitting, how many sittings do I need in a night or a week to cover the cost of the restaurant? So that's the practical way you need to engage with break-even analysis. All right. So determining the break-even, we can determine it graphically, like we've done here by drawing the total revenue and the total cost lines, and where they intersect is about a third of the way between 3 and 4, which is your 3,333. Or you can do it mathematically. So you can either draw it graphically as I've done in Excel, or you can do it from a mathematical perspective. And look, both are fine. Look, this one is as good as anything, just to give you a visual. It's never going to be an exact science. You can't say exactly 333 in terms of the real world, but we can when we narrow it down to an academic setting and we break it into a model like that. All right. So look, these have practical implications. Like if you look at airlines, the break-even load factor, so they call load factor is your occupancy for an airline flight. Like in Ryanair, and I've given you this up on your loop page. If we come back here, Ryanair metrics, this is actually from 2018. They tell you what their break-even load factor is. They calculate it. They said they need about 3/4 of every plane full on average to break even. They actually have booked passenger of 95%. So the difference there, the 95 compared to the 73, that is your profit. They have 22% of their plane is above what they need to cover. So that's giving them the coverage, or what we often call is the buffer or the safety margin. So they need 3/4 of the plane just to break even. Anything above that, then that's their profit. So you can see now where the planes aren't going at all, that's a big issue because it's not covering their costs and they're going to have loss making. All right. So it's important that you understand again that concept, and Ryanair is a very good example where they actually disclose what their break-even load factor is. They go back and calculate it historically what they need to break even in terms of the average passenger fare and the average ancillary revenue. So they say we make about €39 from the average booked passenger fare. We make about €15 from ancillary revenue. So selling tickets, in-flight costs, etc., in-flight food. 39 plus 15. So you're talking about 54, €55 for every passenger. And the cost per booked passenger is 42. So how much of the plane do they need to cover to break even? So it's a very practical way of looking at it. Not every business will disclose that. But internally, in terms of looking at management accounting information, a lot of businesses will look at that in terms of the break-even level of activity. And that is up on Loop for you to have a look through in your own time as well. Okay, so there is different ways of going about the calculations for CVP. And look, at any stage, make sure you pause this now, take it in, go back, read a chapter in a textbook, and come back and look at the rest of the video. You don't need to power through the whole video in one sitting. It may take a bit of time to get into it. So when you're doing calculations with CVP, you can break it into two different approaches. You can either do the full approach, where you restate the whole income statement and do your calculations out for a different level of activity, or you can do the incremental approach. So for example, if I go back here to this one, and we wanted to figure out what is the profit level for 7,000 units. Right? Well, there's two ways of going about that. The first way is the full approach, where I restate everything. So I've given you 5,000 up here. I could restate that all for 7,000. So change the revenue, change variable costs, purchase, change commission, change delivery, and of course the fixed cost will not change. And I could restate the full thing. Alternatively, what I could do for 7,000 is I could say, well, hold on, I can do a shorthand approach. I know every unit generates €6 contribution. So 6 times 7,000 is 42. And I know fixed costs are 20,000 because they do not change. So my profit for 7,000 units, instead of restating the whole thing, is going to be 22. And if I go to my level of output, 7,000, total revenue, 140, total costs, 18. And the difference there is 22. So you can do a shorthand method if you want, using your knowledge of contribution per unit and the way the profitability calculations work. So either approach is fine as long as you're getting the right answer. So for example here, we're using the previous example at Company X, and the question is, if we spend 6,000 on marketing, so we might do an extra marketing campaign, and that resulted in sales revenue of a one-off increase, not an ongoing one, but a one-off increase of 800 units. Should the extra spending on marketing proceed? Now, this is just from a financial perspective. But this is a very practical business question that CVP can help answer. And there's two ways of going about it. The first way is if we come back up here and we look at this statement, we restate it. And we say, if we spend 6,000 of an extra fixed cost, so add on 6,000 there, we're going to get 5,800 units of sale, because you're going to get 800 units extra sale for a one-off period. And that's what this next slide does, is it says you're going to have extra sales. So we're now going to sell 5,800 units at €20 is 116,000. You have 5,800 units at €14 is 81, but you now have 26,000 fixed cost, because remember the marketing cost is a fixed expense. So that tells us that the profit, if we do this, we restate the whole profit and loss account, gets us to 88. What that is telling us is the profit earned here is less than the profit we had earned if we didn't do the marketing campaign, because the marketing campaign has decreased profits. If we just spent 5,000 without the marketing campaign, we'd have made a profit of 10. If we do the marketing campaign, down here, it's going to give us profit of 88. So that's lower than what we would, so you don't proceed. So that's the longer way of thinking about things. Right? There is a shorter way, and a lot of people may have thinking about this now when they're looking at the recording, is what's the shorter way of going about this? Well, a shorter way of going about this would be to think about it in a per unit basis. Every unit, remember, is worth €6. So if we sell 800 units extra, that means it's going to be worth 4,800 contribution. So incremental, over and above what we currently have. But we're paying 6,000 to get that benefit. So you're minus 6,000. So we're actually 1,200 short. And that's where the 1,200 lower comes from. It doesn't make financial sense to spend 6,000 in a marketing campaign that's only going to generate contribution of 4,800. And that's the incremental way you can go about it as well. Is there's actually a decrease in profits here because it's not covering itself. If you wanted to do the marketing campaign, you would have to generate additional sales of 6,000 over 6. You'd need to sell at least 1,000 units. And that's a very practical insight. So again, that could be a one-off marketing campaign. It could be hiring a temporary sales rep for the Christmas period. You need to figure out how much are they costing us and what do they have to do to break even. They often say, what do you have to do to wash its own face, to cover itself? So these are practical things. I know there's simplistic ones here, but you can do the longhand way of restating the whole statement, or you can do the short incremental approach if you can see the relationship between the individual units and the overall cost base as well. And there one questions you're going to see in the question pack, just to get you up to speed and consolidate your knowledge on those basic elements. All right, so again, make sure you pause it now at regular stages. Go back, read a chapter in the textbooks on CVP as well, just so you can hammer home and consolidate your knowledge on those key topics. All right, and of course, you can also use the contribution margin. Whereas if you're told what the additional revenue is, so 800 units at 20 is your additional revenue, and you're said actually you earn 30% contribution, that's still getting you a contribution of 4.8. So just be careful the way that can be presented in questions in the question pack. It can be presented on a per unit basis, or it could be presented as a percentage of revenue, which is called your contribution margin. So it's just the same information, just presented differently. Same with language, you're learning a language here, so you need to learn the different terminologies that are part and parcel of that language as well. All right. So what we're going to look at then for the end of this session is we're going to look at some different uses or applications of CVP analysis. And a lot of these are just a stepping stone above what we've looked at currently. So firstly, we're going to look at target profit analysis. So CVP allows us to say, well, if we want to make a target profit for the year, what's the level of output that we need? Right? Second one is going to look at margin of safety. This looks at how far away are we currently operating from the break-even. So are we very close to the break-even point, or are we 2 or 3 or 4 different iterations away in terms of the chances of this company losing money in this period? We'll then look at different cost structures. What percentage of fixed costs, what percentage of variable costs do you have in a cost base? And why is that important in terms of managing the cost structure of a business? And we call that operating leverage. And finally, then we'll look at, well, we've only really looked at one unit, a business, which is selling one product. That's not really realistic in an overall, in a modern business, in a real world business. So how does CVP work when you have a product, a portfolio of products, and you sell them in a certain sales mix? So we'll bring on that real world iteration as well. So for the target profit analysis, we can calculate how many units must be sold to generate a certain level of profit. Right? So the break-even rate is where you generate no profit. You just cover your fixed costs. Whereas, take the same example again, how many units must be sold in order to generate a profit of 16,000? Now again, try not overcomplicate things. Think about in English what you're trying to do. Go back to the previous example that we had here. We're saying how many units do we need to sell of this to make a profit of 16,000? So try it yourself and think, what is going to be my answer here? Right? Now be careful. If you said 2,666, you're not thinking about the problem enough. Right? If I want to make a profit of 16,000, then I have to cover two things. I need to cover the fixed costs, which is the initial 20,000, and I also need to cover the target profit of 16,000. So see it as another thing to cover. if you got 2,666, you were only thinking about the 16,000. Whereas you still have to cover the 20 initially to break even. You then have to cover another 16,000 to make a profit. So the answer here is going to be 36,000 divided by 6, 6,000 units. And to prove that, think about the calculation. 6,000 units generating contribution of €6 each gets me total contribution of 36,000. Of that, 20,000 must cover the fixed costs, which leaves you with 16,000 profit for sales of 6,000 units. So again, always think about, don't jump into it. We can see here at the 6,000 units, that's where your profit comes from. And you can do that for any amount of profit. If I want to make a profit of 20,000, how many units do I need to sell? So it's quite a practical one, but what often students do in that regard is they forget to include the fixed cost as well. Not only do you need to make your target profit, but you also need to cover your fixed costs initially. So without doing that, you're not going to get the correct answer. And again, no harm at the end when you get your answer, since check it back. Like if you got an answer 2667, you should have been able to since check it. 2667 times 6 gets me contribution of 16. But if I pay my fixed costs of 20, I'm actually making a loss of about 4,000. So when you get these answers, since check that you're getting where you need to be. And that's why I always say, don't just get caught up in the formulas. Understand the problem before trying to do the calculations. What am I trying to achieve here? And do my calculations get to where I want to be? So since check them, because you'd be amazed at the amount of students who just assume it's correct without ever since checking. All right. The other key thing is the margin of safety. And I often call this the buffer as well. It's a sensitivity measure. It's trying to measure how far away are you currently operating from break even. And it's often presented either percentages or presented in number of units. So what you do is you compare the current level of sales, either the budget or the actual, to the break even, right? And if you want to put in a percentage, you put it over the current budgeted sales. Now I'll explain in English what these mean, but this is a quite important one because the bigger the margin of safety, the further away you are from loss making, the further you are away from the break even. But the smaller this is, the closer you are to break even. And that's a risky position because if anything happens, you could end up going from making a profit to making a loss. So the margin of safety in our current example, we were selling, current estimated level of activity was 5,000 units. And we had calculated our break even to be 3,334. Right? So this is all the same example we were looking at before. So that means you have a margin of safety in units of 1666. 5,000 times 334. So you have a margin of safety of 1,666 units. That means your sales can fall by that 1666 units before you break even. Or in percentage terms, it'll be 1666 units over 5,000, which means your sales can fall by 1/3 before the company would make a loss. And you have to be able to interpret that. By how much can your sales fall before you will be loss making, i.e. before you hit your break even and you fall into loss making territory. And again, that's an important insight to look at in a business. If that's very low. Now, these are all relative. There's no benchmark to say low is 10%. But certainly when you're in single digits, you're quite tight there, and any decline in sales at all could wipe out your profitability. So visually, how would that look? The break-even rate is this line here, 3,334 units, and the 5,000 is the current level of activity. So that buffer in the middle is called your margin of safety. That's how much your level of activity can fall before you start to make a loss, before your total costs exceed your total revenues. So they are quite important insights in terms of being able to do or use CVP for practical decision making. So what I would encourage you now before we look at the last two is pause this, go back and look at AC548, particularly in the question pack. I want you to look at the first question, which is called Allcome. That's usually the question we will do in detail in class. I've done a recording of it and you should be able to attempt it now yourself. So there's some shorter narrative ones to start off, but look at the outcome question. Similar enough question to what we're looking at in class, and there's a couple of nice smaller requirements to do in that stage. Once you're happy with that, you can go on then and look at the Gallagher question and move on from there. But certainly start with the outcome question before you move on to the last pieces on this slide deck. And all those questions, as you can see here, they are videos available on YouTube. So make use of those if you want as well. So the second last piece we want to look at is the whole idea of the cost structure. Because if you think about it, you could have two companies doing the exact same thing, manufacturing tables. One could have very high fixed costs because they're very automated production process, whereas another one could have very low fixed costs because they're very labor intensive. And it's very much driven by labor-driven production process. But this cost structure can impact profits, and we call this operating leverage. Right? Now that's distinct from you might hear of leverage in the context of financial or capital structure. Leverage we also talk about. We'll talk about this in the last section in the module around the gearing or the financial structure of a business, the mix of debt and equity in a business. So when you hear leverage, you might hear financial leverage. That's talking about how the business is funded. It's a mix of debt and equity. Operating leverage, we're talking about the cost structure. That's talking about the mix of fixed costs and the mix of variable costs in a cost structure. Higher operating leverage means higher fixed costs. So take, for example, airlines. Fixed costs in terms of staff a lot of the time, fixed costs in terms of the aircraft, and they have to be financed either through leases or repaying debt if you bought them outright. So they have a high level of fixed costs. And that means if they're not generating a level of activity, or COVID happens and the activity falls off a cliff, they're very risky because what's going to happen is they have to still pay those fixed costs. So having fixed costs can have a big issue. The higher the level of fixed costs, the higher the break-even point. Right? So that means in good economic times, high fixed costs can result in significant growth because you have the capacity there. You have the production process in terms of the planes. You have the aircraft ready to go. You have the automated production line, which is much more flexible and um, much more able to put higher levels of output when their demand is. But capital intensive industries, like the car manufacturers, pharmaceutical companies, airlines, they have high operating leverage. But in recessions, that can be difficult because if you have a downturn, either through economic recession or through here an unusual global pandemic, that can rapidly decrease output. But if you have a high level of fixed costs, they don't change. So that's a big difficulty that you want to watch for. All right. Has this company a high level of fixed costs? If so, that is risky and you need to manage that appropriately. So automation typically increases operating leverage because you're automating previously variable costs, whereas outsourcing often has the opposite effect, where you take the fixed cost of running something internally and outsource it maybe on a pay-per-use contract. And we talked about that earlier on in the session, for example, with cleaning contracts in a hotel. If you had a fixed amount of cleaning staff, they could be a fixed contract or fixed cost if you did it in-house, whereas you might outsource the cleaning of the rooms on a per room basis and only pay them for the number of rooms done, which means that you've converted a fixed cost into a variable cost. So it depends the type of business that you're looking at and how you view the costs. But certainly that's important in terms of looking at the cost structure of business and how you manage that cost structure. Because in periods of downturn, whether it's a recession, whether it's a global pandemic or whatever reason, high fixed costs, otherwise known as high operating leverage, can be very risky. And unfortunately, a lot of businesses are finding that out in the current economic environment. So the last one we're looking at then is, well, hold on for a second. You're probably saying most businesses have more than one product. They're going to have a range of products or a portfolio of products. And CVP can handle that as well. We talk about a sales mix. So what CVP needs is, it says you must calculate based on an expected sales mix. So if you have 3 or 4 products in a portfolio, what percentage of product 1 do you expect to sell, what percentage of product 2, product 3, and product 4. So you put them in percentages and you have this expected sales mix. And then we can calculate a break even in these multi-product scenarios by calculating a weighted average contribution per unit. So there is an example of that in the question pack Halo, and I'm just going to use a small example here to illustrate it as well. So take, for example, Alpha. Alpha sells 2 units of A, which is a contribution of €10 per unit, for every 1 unit of B, which is a contribution of €20. And fixed costs are estimated at 160,000. So now we're getting a bit complicated because you don't just sell all of A and you don't just sell all of B. You sell a mix. For every 2 units of A, you sell 1 unit of B. So your sales mix there is 2/3 alpha to 1/3 beta. Because if you sold 3 units as a package, 2 of them will be A, 1 of them B. So what is the break-even point? Now we'll take this in different variations. First one is, let's look at alpha on its own. If we just sold alpha, we would need to sell 160,000 divided by 10. We need to sell 16,000 units of A just to break even if we sold A on its own. If we sold B on its own, we'd need to sell 160,000, which is the fixed cost, divided by 20. We'd only need to sell 8,000. But they don't just sell them in isolation, they sell them as a package. And how we figure out then, well, what is the package looking like? We're saying it's 2/3 times 10 and 1/3 times 20. Because for every 2 units of A you sell at €10 each, you sell 1 unit of B. So if you look at them as a package, you get the weighted average based on the sales mix. Your sales mix is 2/3 of A to 1/3 of B. So you're midway between, well, not midway, but you're somewhere between 10 and 20, depending on the relationship. If that was half and half, then it would be exactly midway, it would be 15. But because you sell more of the lower one, it's closer to 10 than it is to 20. And then you can use this weighted average contribution per unit and the fixed costs. So that's telling us on average we make €13.33 contribution for every unit sold in alpha. Some of them are A, some of them are B, but they're in a fixed sales mix. But again, you have to have used that as an assumption into the CVP model. And that 12,000 units, then be careful, that is A and B together. So that's assumed 2/3 of that, 8,000 will be A, 1/3 of that, 4,000 will be B. And again, you can prove that. Well, let's see what happens then. If we sell 8,000 of A, that's 8,000 times 10. That's 80,000 contribution. If we sell 4,000 of B, that's 4,000 times 20, which is 80,000 as well. And 80,000 plus 80,000 is 160,000 contribution. And that will just exactly cover our 160,000 fixed cost. So whenever you're in doubt about an answer that you get, go back and look and see, does that get me to where I want to be? Does that break even in this particular scenario? And in this one, it does. It gives us exactly contribution equals our fixed cost. All right, so that's a bit advanced. Don't worry too much about it in terms of getting the core concepts. But what you are interested in is, well, there is a real world solution to multi-product companies. And when you're happy with that, go back and look at Halo as well to get an example there. Halo is a good example of where you have 2 products and how you're going to deal with that to get a break-even point for the company. All right. So look, as part of CVP analysis, it is based on assumptions. The same we had at ABC, activity-based costing, in week 2 and 3. There's a certain set of assumptions, we've mentioned these a number of times, you can go back and have a look at, but if any of these do not hold, of course CVP is not going to be accurate. But certain times we have to make assumptions that we can split costs accurately into fixed and variable. That may not always be the case. It may not always be the case that costs remain constant per unit or costs remain constant in total over a particular range. Right? So we have to make these simplistic assumptions to make it work. But the point is, if we're aware of those limitations, we at least have an idea when we're going in that it's not going to be perfect. But using it can still give valuable insights. Ryanair use it, a lot of businesses use it as a concept to think about planning. What is our break-even rate? What is our target volume to make this amount of profit? They're very pragmatic questions that managers have to make and answer. And what accounting does is it gives you the tools to help you make those answers. It doesn't give the answers perfect, but at least gives you a more informed answer. All right? So your key takeaways here is CVP looks at cost behavior. It looks at how the cost structure changes as your activity goes up or down. And it's a very important tool in certain industries, the likes of airlines, hotels, the likes of restaurants, and we're seeing a lot of that now, unfortunately, with COVID. And the dramatic fall in activity is really putting a focus in how are these companies going to break even? What's the minimum level of activity they need to cover their costs? Right. So make sure you have a look through the question pack, have a look at the Ryanair information, and remember there's a lot of videos up there if you do want to go through some of the questions. But for this academic year, this is only optional. This information may be useful when you're looking at budgeting and we're looking at flexible budgets, so it may conceptually help you with that, but being examined on its own, it will not be in this academic year. This will be an optional one, but it may be useful when you're looking at your continuous assessment or trying to fit it into your own role in your organization. All right, so go back and have a look at the information on Loop and also take a look at the Scoopit for some relevant articles. The next session we will look at is another optional session. It's the relevant costing, which it looks at more one-off decisions. So we'll look at the example of Irish Water, of how they're trying to make a one-off decision there to close it, and how different people can view costs in different ways. All right, so we'll figure out that and we'll have a look at that up on Loop, and I will send an email around as well. So in this recording, we looked at routine decision making and how management accounting, particularly in the form of CVP, cost volume profit analysis, can help managers make more informed decisions.